Hi, this is Nilus Mattive for Money and Markets TV. My daughter Vela's 4th birthday this weekend has got me thinking about the passage of time and an investment approach that puts it to work for us rather than against us. It's called dollar cost averaging, and it's relatively simple. You buy equal dollar amounts of the same investment on a predetermined schedule. For example, let's say you decide to invest $10,000 in XYZ Corporation. Rather than deploying the entire amount at one time, with dollar cost averaging, you would purchase $1,000 of XYZ stock in each of the next 10 months. When the price of XYZ is higher, your $1,000 will buy fewer shares, and when the price dips, your $1,000 will buy more shares. The logic behind this approach is that it reduces your risk to a stock's short-term price movements. It automatically encourages you to buy more when prices are lower and less when prices are higher. Plus, it removes much of the emotion from the investing process. You've already committed to buying the stock at regular intervals, regardless of market conditions. And best of all, since you're doing it automatically, it doesn't require more than a few minutes of your time, if any at all. Obviously, buying bits of stock as the market continually rises would work just fine, even if it meant you missed out on some additional upside by not putting as much in as quickly as possible. But what about the other scenario, in which the market really zigs and zags, moves sideways, or even goes lower over a long period of time? Well, the past few years give us a perfect real-world example of this kind of action. We've seen huge declines and rallies during that time, but the S&P 500 is still lower than it was 4 years ago. Of course, if you had good timing, you could have made a fortune at every one of those big turning points in the market. But what if your timing wasn't perfect? Or what if it was bad? That's where dollar cost averaging comes in. I looked at what would have happened if you invested $1,000 in the S&P 500 ETF every month over the last 4 years. You would have spent a total of $49,000 to buy 441 shares in SPY. And today, you would have more than $58,000, a total profit of more than $9 grand. Here's another way to look at it. You would have gained about 18.7%, even though the market actually fell over the same period. The reason is simple. While you would have bought some shares when the market was at its peak, you also would have forced yourself to buy a bunch of shares when the market was much lower than it is today. You can use dollar cost averaging when buying individual stocks too. And you can also put this philosophy to work whenever you reinvest your dividend payments or make regular contributions to a retirement fund like a 401k. Of course, whether or not you decide to use dollar cost averaging in your portfolio, the important thing to remember is that while time often passes more quickly than we might like, the key to success, in both investing and in life, is finding a way to capture those key moments that happen along the way. For Money and Markets TV, I'm Nilus Mattive. Thanks for watching.